Okay, I might get the ball rolling. Hopefully, people are here. People are joining in. So, welcome to this presentation on blockchain's offspring, regulation of blockchain's offspring, digital currencies, tokens, and organisations. Before we begin, in accordance with custom, I'll acknowledge the traditional inhabitants of the respective lands on which we all reside, and in relation to Monash University, that would be the Kulin Nation. So we acknowledge their elders past and present. So blockchain and its manifestations is the topic today. Now, I think two certainties in life: death and taxes, and a third may be that where we have people interacting with each other and with corporate entities, sometimes investing money, and the money sometimes increasing in value, sometimes reducing in value, and correspondingly we have others, I guess, promoting those entities or investments, and possibly receiving fees and so on. Whether this involves technology or not, inevitably the law at some point is likely to take an interest in these activities, and I think that's already happened to some degree, but not totally yet in relation to blockchain and its manifestations. And that interest of the law may be proactive, or it may be somewhat reactive. And proactive, obviously, where legislatures set the agenda, set the rules of the game in advance. But that sometimes doesn't always happen because the technologies may be very new and imperfectly understood, and so the legislatures may be playing catch up a little bit in relation to those matters. And certainly the reactive part can also occur in relation to matters coming before the courts, where judges find themselves in a position to try and work out how these phenomena fit into existing regulatory regimes, if indeed they do fit within existing regulatory regimes, and if they don't, how they are governed and how far traditional methods of governance, contract and so on are relevant to the governance of these types of phenomena. So we're grateful today to have four very excellent and very expert speakers, both locally and overseas. And the structure of today's webinar will be firstly that we will have initially Professor Julie Cassidy from the University of Auckland, who will talk about the regulation of digital currency, principally in Australia and New Zealand. Professor Ross Buckley of the University of New South Wales will talk about central bank digital currencies, CBDCs, because it's always good to have an acronym. And he'll also talk about CBDC, central bank digital currencies, in relation to China. And I think what happens in China matters in this space. Professor Jason Harris of the University of Sydney will talk about the DAO, which is another acronym, but it's not the Dow Jones, it's the DAO, the Decentralised Autonomous Organisation, which is another manifestation of blockchain technology. And lastly, we're very pleased to have Lee Reiners, who is the policy director at the Duke Financial Economics Centre at Duke University in New York, who will give us the US perspective, and certainly what happens in the US in this space certainly matters. And I'll also add that it's quite late in New York at the moment, so thank you, Lee, for making yourself available. There'll be questions at the end, and you can ask questions by using the chat function or raising your hand. So without further ado, I will introduce Professor Julie Cassidy, who's a Professor of Law and Taxation in the Department of Commercial Law at the University of Auckland. Her primary fields of research are taxation, including anti-tax avoidance measures, capital gains tax, and cryptocurrencies, company law, including directors' duties and corporate governance, and human rights. And Julie's current research includes regulatory models for cryptocurrencies, including the taxation and securities treatment of those assets. So welcome, Julie. Julie, we can't hear you.
Oh, yes, sorry. You've got to stop sharing your screen before I can share my screen.
Okay, fine.
Yeah, sorry, technology. Okay. So while I've got my assistant here, so while he's setting it up, kia ora and g'day. I've been asked in 15 minutes to do 3 things. I don't know that I'll be able to, but let's have a crack at it. So one of the things that Michael has said to participants is that we're not expecting everybody here today to be experts in terms of cryptocurrencies. So particularly in light of the symposium title, I'm going to start by very briefly talking about what is a cryptocurrency. And we're going to see the reason why that's important is that unless you understand what a cryptocurrency is, trying to work out a regulatory framework is going to be difficult. Then, as Michael has said, we're going to look at, well, I'm going to look at the position in New Zealand and Australia, and I'm going to have to do that very briefly, but I'm happy if people want to contact me and I could actually send you more detailed slides. So we're having a little bit of a technology problem here. So let me just see if this works. Yeah, it's not moving. Yes, it is. Okay. So the thing about cryptocurrencies is that, and I think this makes it really hard for you at first to get your head around, is that they are entirely digital. I must admit, when I first came into this field, I thought Bitcoins were actually Bitcoins. I thought they were coins, but they're not. It's entirely digital. And the hard thing about it being entirely digital is that cryptocurrencies are inherently have no value because they are entirely digital. Their value purely lies in the essentially an acceptance between participating parties that they wish to give that cryptocurrency, and in particular the digital file, a value. So this makes it really difficult for us in terms of thinking about regulation. Another key aspect of cryptocurrencies is the use of cryptography, hence the notion of crypto. Now, the reason why this is really important, in particular in a regulatory framework, is that because cryptocurrencies use crypto, it is totally anonymous. And the third point relates to this as well. We don't have a bank in the middle. We don't have a sovereign nation in the middle. It all works by the parties anonymously talking to each other. And that anonymity, being anonymous is potentially problematic because cryptocurrencies have been used for naughty purposes, such as the dark web and money laundering. And this can occur because it is anonymous. It's crypto. Now, something I think Ross is going to talk about, we do have stable coins emerging. And in terms of China, they are not going to be anonymous. So China's stable coin, the exchange is actually detailed. And actually in Japan, the exchange has to provide the government with information. But typically they are anonymous, and that's a key feature to them. But as I say, apart from what Ross is going to talk about, typically cryptocurrencies are not issued by a sovereign nation. They're not part of the Reserve Bank. And as we'll talk about later in this panel, China is an exception in that regard, and most recently, El Salvador. But what I wanted to do in that very brief discussion is, where does blockchain fit with cryptocurrencies? Now, how it works for the novices there is that each time there is a transaction with a cryptocurrency, the network talks to each other. Okay, so the network talks to each other, and technically it's the computers within that network talk to each other and they record that transaction. And what transactions in cryptocurrencies involve is sealing off each transaction. And this is where blockchain technology comes in. So what we're doing is sealing off blocks of information on the ledger as the network, computers in the network talk to each other. Now, we don't have time to talk about it today, but to encourage this discussion, we have what's called mining. So people are encouraged to seal off the transaction using blockchain, dealing with a complex algorithm, but as a result of that process, they are actually given what's called native tokens, but we don't have time. So I've got the slide there that talks about how it works. So you've got block number 1, it's sealed off. Then block number 2, it's sealed off. Block number 3. Okay. Just briefly in New Zealand. New Zealand has been very strong on the principle that cryptocurrencies are not a currency. They're not local currency, they're not foreign currency. For all purposes, and this is really important that it's for all purposes, it is treated as a commodity. It's property. Now, what the government has said is that it is akin to gold bullion, and this is really important. So in terms of taxation, if you are buying and selling cryptocurrencies, you're buying and selling property, it is trading stock, and the profits will be business income under CB1. We don't have a comprehensive capital gains tax. We have just an array of ad hoc provisions. And the relevant ad hoc provision in the context of cryptocurrencies for people who are not in the business of buying and selling is CB4. And what CB4 catches is personal property that has been acquired with the dominant purpose of profit making by resale. And this is where the gold bullion comes into play as being very important. Most of the case law dealing with CB4 is dealing with shares. Not all shares are bought to be sold at for resale at a profit. You may have wanting a dividend stream. You may want to have long-term profits. By making it akin to gold bullion, we don't have the problem with shares. Gold bullion doesn't give you membership rights. Gold bullion doesn't give you dividends. You only buy gold bullion to sell at a profit. So that's really important. As I say, in New Zealand, it's treated as property, a commodity for all purposes, including GST. There was a recent IRD statement, and the first line of this IRD statement dealing with GST says cryptocurrencies are property. So it has reinforced that fact. It has said that certain transactions will not be caught. It doesn't really explain why, but I think it's because parties will not be registered for GST. But if you use cryptocurrencies to buy services, to buy products, GST must be charged. We're going to see that's very different from Australia. It is, in terms of company law, securities law, it is considered a financial product. The authorities have said it's either a debt security, equity security, it's something, but it's going to be caught. But let's have a look briefly at Australia. Now, the Australians will probably hate me saying this, but Australia is schizophrenic. And what I mean by that is that cryptocurrencies are treated as a commodity property for CGT purposes, for income tax purposes, but as a consequence of pressure from the fintech market, the legislation was changed, and it through the pressure of the fintech lobby, we had a Senate report, we had a report by the Productivity Commission, and as a consequence of this pressure, the GST provisions were amended to include a new product, so to speak, called digital currency. And under this amendment, cryptocurrencies are digital currency. They are akin to a financial product and therefore exempt. So that's sort of, in my mind, not productive to have it as treated as property for CGT, for income tax, and then for GST to say it's an exempt financial product. I don't think that's actually a really good approach. So I was recently asked by the Taxation Board and Treasury to be part of a panel, and this was one of the questions that they asked me. How should we define cryptocurrencies, and should there be one definition? I personally think, as in New Zealand, it should be one definition. It should be treated as property for all purposes. It's a bit unclear in terms of securities law. The ASIC is looking at how it can regulate it in the future. Okay, so this is just a little bit more detail in regards to the tax position. I think I've still got a couple of minutes. So as I say, because it's treated as property for income tax purposes and CGT purposes, for income tax purposes, it's treated as business income under Section 6.5 if you're trading in cryptocurrencies. If you're not trading in cryptocurrencies, then we turn to the CGT provisions. And it's quite clear, according to the government's approach, that it is an asset under Section 108-5. And when you sell a cryptocurrency, we have CGT event A1, the disposal of an asset. So for income tax purposes, for capital gains tax purposes, these are the leading provisions that will apply to cryptocurrencies. Now, as I say, in the GST context, originally it was treated as property, and therefore 10% GST was applied to those transactions. But as outcome of the fintech lobby's pressure, we have this new definition of digital currency, and so it's exempt for certain reasons. So under the approach in terms of GST, it's only going to, GST is only going to apply where you use digital currencies to buy other digital currencies. But what's key to this is that, therefore, if you are using cryptocurrencies to buy property, to buy services, it is an exempt financial product because it is, as I say, a digital, this new notion of a digital asset. So, oh, sorry, I've gone the wrong way. Technology. Okay, so in conclusion, characterizing your cryptocurrency is going to be key. We don't have a single accepted definition of cryptocurrencies. How they're going to be treated depends on your jurisdiction, what your government says. So one jurisdiction, for example, China, has banned cryptocurrencies. So they've really moved offshore to Hong Kong and Japan. Japan has been accepting it as currency for a considerable period of time, but it is quite regulated. The exchange platforms are quite regulated. Then, as I say, in New Zealand, it's treated as property for all purposes. In Australia, it's treated as property for some purposes, financial product for another one. So ultimately, because there is no universal definition of cryptocurrencies, its nature will depend on how your government characterizes them. Now, there's lots of other really interesting issues that will need to be addressed, picking up on Michael's point. So one of the things I've recently presented on is hard forks. So when there is actually a split of the cryptocurrency, what's the tax effect of that? Interesting issues that have not been addressed is the application of source and residence rules. Are we going to look where the taxpayer is? Are we going to look at where the exchange is? That's going to be a difficult question that regulators will have to consider. And obviously, these source and residence issues also relate to the tax collection process. In my class last week, one of my students was saying, how does IRD capture this money? You know, where are these people? Where are the exchanges? And it's a really good question, but it's something that we have to consider. So in my 15 minutes, I've done it. So I don't think I've gone over time.
Thanks, Julie.
Thank you. I'll stop sharing.
Thanks for the opportunity. Thank you. So yeah, look, I think that highlights some of the complexity. Hopefully it's going to be orderly complexity, not chaotic complexity. I guess that remains to be seen. And also, I guess you highlighted the Australia and New Zealand, as usual, are similar, but different as well. So thanks, Julie. Now I'd like to now introduce Ross Buckley, who is the KPMG Law and King and Wood Mallesons Professor of Disruptive Innovation at the University of New South Wales. Ross's research focuses on fintech, regtech, central bank digital currencies, and the consumer data right, and more broadly, the full range of issues that the rise of data and its algorithmic analysis pose for society. Ross is in receipt of a substantial ARC Laureate Fellowship, being a large $2.6 million project exploring how Australia might best regulate the rise of data and its analysis so as to seize the related benefits while also managing the risk. So welcome, Ross.
Thanks, Michael. Now, do I have to do anything or am I up on screen?
You're there. Yep, you haven't got slides, I don't think, have you?
No, I don't have slides.
Yep.
Okay, so it's all working?
I hope so.
Okay, good.
I believe so, yeah.
Good, okay. And thanks to Julie for a good introduction of cryptocurrencies. I'm going to make it a bit more complicated now by saying initially, I don't think cryptocurrencies are currencies, right? They're the hype. It's all the hype and excitement around them. But a currency is defined as a store of value, a unit of account, and a means of exchange. That's the classic definition. And cryptocurrency only satisfy the means of exchange piece. You can't store value in them. You can't use them to price things because their value bounces around too much. The reason their value bounces around too much is there's no real use case for them, right? Julie mentioned the dark web. They're very expensive to get into and out of. So unless you're a criminal or a money launderer or wanting to trade on something on the dark web, you're probably not going to use one. Excuse me. Doesn't mean they haven't been incredibly popular, but I don't think where they are where we're headed. Where we're headed is central bank digital currencies. And to make things complicated, that's very different. As Julie said, there is nothing behind a cryptocurrency. It's purely people creating demand because they're speculating on it, basically, or they want to use it for illegal activities. So it's the demand to use the thing, the piece of technology that creates the price, but that's why the price moves so much. Central bank digital currency is totally different. It is the currency of the country in a digital form. It's protected by cryptography. So think a digital Australian dollar, digital US dollar. It's the same thing. It's central bank money. So, but just delivered differently. So you might think, well, that's not a big deal, right? It's the same thing. But the difference is that it's central bank money. Because today in Australia or New Zealand, the only time you or I deal with central bank money is when we're using cash. And increasingly, at least in Australia, we don't use cash, right? Cash is, rarely used. What we use is commercial bank money. It's promises by commercial banks to pay MasterCard or Visa or pay the merchant or whatever. So from a consumer's point of view, when we eventually move to a large extent from commercial bank money to central bank money, consumers probably won't notice that much difference, but the architecture is different. Totally, the architecture behind it is different. The law is different. If you use a token-based central bank currency to send money from New Zealand to Tonga, you've sent a thing. You haven't sent a promise, you've sent a thing. If you use account-based CBDC to send a remittance from New Zealand to Tonga, you've sent a promise. So the law of things is property rights, very different than the law of promises. So we're changing fundamental whole legal architecture by going from regular currency, which is commercial bank money, to central bank money. Now, this is a difficult area to talk about because with a couple of slightly dodgy exceptions like Nigeria, there is no CBDCs in full operation yet. None of them have been launched. China leads the world. China's been working on it since 2014. America has finally woken up this year that this is going to be really insignificant. The EU woke up about 2 years ago, but the developed world is a long way behind China on this. And there's really fundamental design distinctions you've got to arrive at to be able to build one of these things. So you can have it account-based, which means that people's holding of CBDC is recorded on an account somewhere. Or you can have it as token-based, which are tokens are little pieces of software that live on your phone. Most developing countries will go token-based because they need to be able to serve people who don't have internet access at times or don't have electricity at times. So token-based allows you to do things with the money until when you're offline, until you come back online. But one fundamental difference is account-based or token-based. Another fundamental difference is whether it's retail or wholesale. The Reserve Bank of Australia has done a big project on wholesale CBDC and found some really significant savings in the back office operations of banks, in syndicated loans, in that sort of thing. I would think there's not a pressing use case for retail in Australia because our payment system is so good. Our tap and go, new payments platform works so well. But it's confusing because when you read most of what's written about this, most places around the world don't distinguish between retail and wholesale, but they're really quite different things. And on this one, I'm with Ravi Menon, the head of the Monetary Authority in Singapore. He thinks most of the juice is in wholesale. Most of the benefits are going to be in wholesale CBDCs, and I agree with him on that. That's where the real benefits are. The other thing to make it a bit more complicated, Julie was absolutely right, cryptocurrencies run on blockchains that run on distributed ledgers. Blockchains are just a tamper-proof way of recording data. CBDCs almost certainly won't run on blockchains. So it's strange in a way. They're always discussed in the context of blockchains, but blockchains are a classic solution if you've got a trust problem. You've got a trust problem with cryptocurrencies because, as Julie said, there is no central entity. There's nobody running it. There's no government in the middle of it. If you have a trust problem with your reserve bank, you've got a much bigger problem in your society than whether you need central bank digital currencies. Central banks don't normally have trust problems, and blockchains running on distributed ledgers are relatively slow. So almost certainly, central bank digital currencies will run on single centralized ledgers. That's what Japan proposes to do. It's what Sweden proposes to do. There's a tremendous amount of work being done on this. The Bank for International Settlements released a report in April or May, I think it was. 92 countries' central banks are working on central bank digital. So why is that? I've just said we don't need them for retail in Australia. Well, the reason is some countries do need them. The US needs one, I think, because its payments system is very antiquated compared to ours. So some countries need them to improve retail payments. All countries would benefit from CBDCs wholesale in capital markets. That would save a lot in all countries. Some places like Sweden have particular needs because in Sweden, cash is 70% of bank branches in Sweden don't carry cash. Virtually you can live in Sweden for years now and not use cash. So if you read the Swedish Central Bank's report, it's very obvious. It's very uncomfortable with the idea of the central bank going out of the money issuance business. It wants to issue a central bank digital currency because otherwise it's going to have to trust the Indigenous people in the north of the country, poor people, elderly people. It's going to have to trust MasterCard and Visa to meet those people's payment needs. And they don't. They think it's their job as the central bank. So Sweden has a particular need. China, for a long time, I've been tipping China would be the first in the world to go with a comprehensive CBDC, and that's what's happening. That's very clear now. China's already trialing it in a good part of the country. There's still a lot of transactions happening. China's motivations are unique again. CBDC is programmable money, so it can be allowed. You can be allowed to use it for some reasons and not others. If the Chinese government decides decides Michael has an alcohol problem, he goes along on a Friday night to buy some grog for the weekend, his CBDC might be programmed not to work. It'll work for Julie, but it won't work for Michael, right? You can program it down to that level. I'm sure you don't have a drinking problem, Michael, just an example. And but also the information with CBDC ends up in the government if the government wants it, and the Chinese government wants it. They've got an insatiable appetite to know what their citizens are doing. So they've also got a financial exclusion problem. A lot of Chinese people don't have, a lot of the country's very developed, some of it's underdeveloped, and they don't have good access to payments. The ECNY, as they're now calling it, will solve that. So in China, it ticks a whole lot of domestic boxes. So that's why China is years and years ahead of anywhere else in the development of it. But the biggest reason of all, and this is why China is going to eventually, I think, force, this is why 92 central banks are working on it. They all know China's going to force their hand. China's going to force their hand because China is sick and tired of the benefits the US gets from minting the global reserve currency, right? The global financial system currently works, the major reserve currency is the US dollar. The US gets tremendous economic benefits from that. You know, most of its trade transactions, it doesn't have to hedge for foreign exchange risk. It doesn't have foreign exchange expenses. It has a lot more capital inflow than it would otherwise. Many strong economic benefits. So strong, Barry Eichengreen, one of my favorite economists, described it as the US exorbitant privilege from minting the global reserve currency. Well, China wants some of that exorbitant privilege. And basically, it also wants to be able to design now an international financial system after what the West did to Russia early this year, an international financial system that is beyond the reach of US-led sanctions. And US sanctions only bite because the US dollar has to be settled in New York. So if there was another major global reserve currency, China wants it to be the ECNY, then it could develop a parallel currency bloc that would be beyond the geopolitical reach of the US. And that's enormously attractive to China. And that is going to require, and so this is a long way away for China to do this. It's got a lot to overcome, but it's been on this track for more than a decade of wanting to, share the global reserve currency space with dollars. And a digital currency allows it to do that better than almost anything else that I can think of. So China will keep working towards eventually, in my view, releasing the ECNY for use. It'll be free or very cheap. It'll work extremely well. It'll be released for use in offshore trade. And at that point, other countries will want their own digital currency. Because if Australian companies start to settle their trade with China in ECNY, which they profit-making companies, they probably will want to, because I'm sure it'll be cheaper and quicker and more efficient than anything else. The data from those transactions will end up in Shanghai or Beijing. They won't end up in Sydney or Melbourne. So the Chinese government will have a real-time read on the trade situation that the Australian government won't have. That will be intolerable to the Australian government. So nations around the world are working on it, and I think they know they're going to be led there by China. But the reason that China's been on it now for 8 years is this is not a simple to re-architect the monetary system that has been the same way for centuries is a very tall order. And reserve banks are understandably very cautious beasts. So to summarize, cryptocurrencies are what all the excitement have been about so far. I don't think they have a great future. Central bank digital currencies is what the focus of research right around the world on central banks, and it's an incredibly in-demand topic. Where you'll hear the phrase crypto assets, cryptocurrencies in the Australian regulatory system, the asset regime, are now called crypto assets. And I think that's right, because as I said, they're not currencies. They don't work as currencies. They work as speculative assets. We should call them what they are. Having said crypto assets aren't important, cryptocurrencies aren't important, I think crypto assets really will be, because where we'll eventually get to is the tokenization of a lot of property. So we'll have tokens that represent real estate, tokens that represent trade transactions, tokens that represent vehicles, and we'll be trading and taking security interests and registering title through those tokens. That's a long way away, but that's coming, and those tokens will be crypto assets. So we do need a really good regime for crypto assets, because that's where we're heading. But again, that's quite a way away. Well, that's enough from me. I'll hand on to Jason.
Thank you, Ross. Some food for thought there. So it's bigger than regulation of currencies, and obviously when we're talking about payment systems and international currencies and whatever, then as you've indicated, we start to move into geopolitics as well. Very, very interesting. All right, I'll now introduce Jason Harris, Professor Jason Harris, who's a professor of corporate law at the University of Sydney. Jason's work is frequently cited in Supreme Court and Federal Court decisions, has been cited in the High Court, as well as by Commonwealth parliamentary committees and academic works in Australia and internationally. Jason's an active participant in law reform initiatives through his policy work with the Governance Institute of Australia, the Australian Institute of Company Directors, and the Corporations and Insolvency Committees of the Law Council of Australia. Jason has served on a number of editorial boards, including for the Australian Journal of Corporate Law, the Australian Law Journal, and the Journal of Banking and Finance Law and Practice. Welcome, Jason.
Thanks very much, Michael. Thanks to Ross and to Julie for their excellent presentations. And to a certain extent, we've had a bit of light and a bit of dark in terms of where we're going with blockchain and crypto. And the topic that Michael's asked me to talk about really fits pretty squarely within that spectrum of both light and dark. So Michael's asked me to talk about Decentralised Autonomous Organisations, or DAOs. And this is something that I think is fascinating. It's fascinating as someone who's a company lawyer to really think about how different types of organisational groups fit or perhaps don't fit within our system of corporate law. And if they don't fit within our system of corporate law, then how can we characterise them? So what laws might apply and what laws might not apply? I think it's interesting in this space, reading about different uses of DAOs and more broadly blockchain technology. Sometimes you'll hear references to, or you'll read about references to, the underlying technology is illegal. So it's not illegal necessarily, it's illegal. It's beyond the borders of any one jurisdiction, and that's for sure. But one of the things that we are very confident of is that even if you assume that your particular form of electronic collective organization, foundation, whatever you want to call it, that at some point you have to touch various real world institutions and you will be subject to law in some way. It might not just be the Corporations Act here in Australia, it might be other laws as well. So it's kind of interesting that people are setting up these things, calling them DAOs and saying, oh, no law applies, we're everywhere and we're nowhere, the kind of crypto anarchists. And that's all fine until someone actually wants to collect money or actually pay some money or actually do something with the money that's notionally being provided with them. So when we talk about DAOs, there's been a lot of talk in Australia over the last couple of years, in part driven by a particular federal politician that we have here in Australia, Senator Andrew Bragg. He was previously in government. His party lost government at the last election, but he chaired a parliamentary committee that was looking at turning Australia into a technology and financial hub, and part of that looked at the need to recognise DAOs. So what are DAOs? So Senator Bragg has said in more recent public talks, including in Blockchain Week this year, that DAOs pose an existential threat to Australia's tax base, that they're going to take over the modern company, and in the future, everything will be a DAO. We won't have companies anymore. They'll all be DAOs. So we better get on board pretty quickly and start recognising them. So what do I mean by a DAO? So a DAO essentially is an organisation that uses a decentralised governance structure that is operated over a blockchain, that essentially is governed by terms that are set out in the smart contracts that operate on the blockchain, and that the users of that DAO we would usually call token holders. So one way of thinking about this is a little bit like a company. So we've got an organizational structure, we've got some rules. In a standard company, we would call that maybe a shareholders agreement, maybe the corporate constitution, or those of a certain age might think of them as articles and memorandum of association. So with a DAO, all of that basically is encoded onto the blockchain using one or more smart contracts. The thing with conceptualizing token holders as like members of the company, we might refer to them as members of the DAO, is that with the tokens, they're held in an electronic wallet. And so, we might look at the structure of a DAO and say, well, here's where all the tokens are. This particular wallet has this number of tokens. So that might mean that they have this number of votes, depending on what the internal rules are. But of course, that's just a digital wallet. So there might not be a real person behind that. There might be a real person or a group of people or a company or some other separate legal entity that holds multiple digital wallets that have various tokens. So it's not like looking at a share register and saying, well, here's, Jason Harrison, he's got 100 shares in BHP. Of course, we can have, nominee companies and these types of things that own shares in companies. So tracing beneficial ownership is tricky with standard companies as well. So really, we're talking about decentralized, tokenized decision-making that is operating on a blockchain. So a DAO can operate on a public blockchain like the Ethereum blockchain, for example, and most of the DAOs that we have out there, which are tracked on various websites, in fact, over 4,500 DAOs are operating on the Ethereum blockchain right now. But a number of DAOs are operating on their own separate blockchains. So, for example, the Waves blockchain, EOS, Solana, and Cardano, to name a few. I guess one of the big differences between a DAO and a standard company, or indeed many different types of business forms, is that DAOs tend to have a fairly flat management structure. So there's no need for a separate board of directors that's going to make decisions that's then imposed on the members. The idea behind a DAO is that effectively the token holders are going to be voting on different proposals using their tokens and whatever voting mechanism is set out in the terms of the smart contract. And in fact, you could set up a DAO that has no directors whatsoever, that it's purely member driven. Now, from an Australian corporate lawyer's perspective, that sounds very weird because all of our companies have boards of directors. The idea is that shareholders vote for or against the directors, but that the management power of the company is vested in the board. But if we think about DAOs from a comparative corporate law perspective and look at some of the other types of separate legal entities that we can see in other jurisdictions, in particular, the limited liability company form that we see in North America, there are, in fact, forms of LLCs in North America that have no boards of directors. They're called member-managed LLCs. And indeed, what we're now seeing is that some of those jurisdictions overseas, particularly in America, for example, Wyoming, Ohio, Tennessee, various jurisdictions are then saying, well, we can use a DAO as an LLC and we'll just call it a DAO LLC. And so they're amending their statutory regimes to recognize that you can have an electronic LLC. So there is a way to adapt that, but it just seems very weird from an Australian perspective because we don't have any entities or at least up until very recently, that didn't have a board of directors. I say up until recently because one change that we had to Australian corporate law on 1 July this year was the introduction of the Corporate Collective Investment Vehicle Structure, or CCIV. And this is the first time that we've permitted a company in Australia, which is limited, to not have a human director. The CCIV actually only has a corporate director, and that's it. Now, the corporate director is itself a corporation, which then goes on to have natural persons as director. But maybe we are starting to see some changes here in Australia. Okay, so what can we use DAOs for? They're kind of interesting. They're a bit different to what we have in Australia. What can we use them for? A broad range of different purposes. So we could use them to facilitate collective investment vehicles. So if you think about kind of venture capital funds, private equity funds, managed investment schemes, you can use a DAO for that purpose. So you're essentially selling the tokens to members who are then investing in the DAO, pooling those resources together, and then using the DAO's decision-making processes to decide how are we going to spend the money that we're collecting, how are we going to invest the money. So that's one popular way to use a DAO. It doesn't have to be for a for-profit purpose, though. So we have seen overseas a number of DAOs that have been set up for charitable or not-for-profit purposes. One particular DAO that got a lot of publicity earlier this year was the so-called Constitution DAO, which was set up in the US, that pooled literally millions of dollars for the purpose of buying an original copy of the US Constitution, which was being auctioned off. They were not successful, but that's one example. So you could think about this a little bit like a GoFundMe or a Kickstarter type project where people are pooling investments for a particular purpose. It can be to run a business, but it doesn't have to be to run a business. And indeed, many of the foreign jurisdictions that are allowing DAOs as part of their legal business structures are only allowing them for not-for-profit purposes. We'll get to that in just a minute. We can use a DAO for the internal purposes of the company. So we might think of a DAO as being a little bit like a separate entity, which in Australian law currently it is not, but we might think of it in that way. And so if you like, the company is the DAO. On the other hand, we might think of an internal DAO within a company. So take the company's existing internal management rules, the corporate constitution, voting procedures, etc., and then we put that on the blockchain. And that then is the DAO. So the shareholders become token holders, but perhaps employees become token holders. Perhaps customers become token holders. Suppliers become token holders. So we can use a DAO inside an existing corporate structure to facilitate deeper levels of engagement with corporate stakeholders. That's one way to think of a DAO. We could also use a DAO, and it is being used, some of the largest DAOs in the world are being used to conduct decentralized marketplaces. And there are DAOs out there that have literally raised billions of dollars to conduct decentralized online marketplaces and also to run decentralized online asset custodial arrangements. So quite large DAOs operating in that context. One of the more novel uses of a DAO is as an online dispute resolution marketplace. So, for example, let's say you set up a DAO to run your business, and then there's a dispute between some of the token holders. How are we going to resolve that dispute? Well, perhaps we could go off and seek to resolve it in court and say, well, this is a legal contract, or this is breaching the Corporations Act or something. Well, what we can do is we can actually refer it to the DAO court. So there's something called the Court of Aragon, and Aragon was one of the initial DAO providers who undertook, for a fee, of course, to set up internal DAO processes inside companies to deal with enterprise risk and compliance procedures. Aragon has then set up its own external dispute resolution mechanism, which is called the Court of Aragon. And unlike going to a court where you get a decision and you move on, in the Court of Aragon, you actually have rounds of dispute resolution. So the token holders of the Court of Aragon will then vote on how to determine that particular dispute, and then there's a process for appeals. So that's a fairly novel way. Okay, mindful of the time, how does this fit within the existing legal structure? So clearly it's not a company. A DAO is not registered as a company limited by shares or a company limited by guarantee under Australian law. Most of the narrative that we see here in Australia would characterise a DAO as a partnership. And indeed, that's what Senator Bragg has described it as, and that's his line about the threat to the tax base, because we're going to be taking away from corporate taxation receipts. I must admit, I completely disagree with that. I don't think a DAO, certainly for commercial or not-for-profit purposes, can be characterised as a partnership, mostly because the essence of a partnership as a legal matter is having mutual trust and confidence between the partners. So partners are in a fiduciary relationship. They're working closely together in the same business. We really can't say that with a DAO. If anything, I think a DAO is perhaps more like a managed investment scheme, although if you don't then have a central coordinating body who's determining what to do with the pooled funds, that makes it a bit difficult. It would clearly be an unregistered managed investment scheme, so query whether we need to set up a responsible entity and then have it registered as a bit like a public unit trust. Some types of DAOs look a little bit like a trust, but again, if you don't have a trustee, that makes it a bit difficult. It's possibly more like an unincorporated joint stock company from the 19th century, or perhaps an unincorporated association, particularly if we're dealing with not-for-profit status. So if we look to overseas as to how DAOs have been treated in different jurisdictions, I said to you at the start, the United States certainly has looked at introducing DAO-specific laws. So Wyoming is the state in the US that's probably gotten the most publicity, and they have their own specific DAO LLC legislation. But a number of other states, as I mentioned, Ohio, Tennessee, have looked at introducing DAO-specific laws, and then other jurisdictions, most notably Delaware, has specifically recognised certain aspects of DAOs, although they haven't specifically changed their LLC law to deal with DAOs. Looking beyond the United States, the Marshall Islands has recently introduced a DAO-specific law, and then a number of other jurisdictions, Singapore, Switzerland, Liechtenstein, there's a few others, the Cayman Islands. What they've done is adjust their existing laws that relate to foundations, which in some of those jurisdictions can only be a not-for-profit. In other jurisdictions can be a for-profit foundation. And importantly, with a foundation, you don't need to have any members. So you basically donate to the foundation by purchasing your tokens. So you swap your real currency for crypto like Bitcoin or ETH, and then swap that for the DAO token. Oh, whoops, that's telling me that I've run out of time. And so those foreign jurisdictions have allowed their specific foundation laws to be used for DAO purposes. So what should we do here in Australia? As I said, Senator Bragg has recommended in his Senate report that we should be recognising DAOs as their own type of separate legal entity. At present, we don't have any draft law reform that would do that. There is a body of crypto lawyers out there called Koala, and they have produced a DAO model law, which can then be introduced into different jurisdictions. So it remains to be seen what happens here in Australia. My personal view, I think we probably should recognise DAOs under the Corporations Act. We could look to the US as an example and create a kind of hybrid business structure. Think of the Constitution basically as the smart contract operating on the blockchain. But there's a lot of issues that we still need to get through. The recognition is just one, the capacity to recognise the DAO as a separate entity, able to hold property, albeit on the blockchain in electronic form. But then how do we deal with things like directors' duties? If you don't have any directors, if you don't have any officers, if it really is just the group making decisions, the token holders, what does it mean to say that you've got directors' duties? How would that apply? How do we deal with transparency issues? So what sort of auditing requirements, financial reporting requirements would we have? We just need to recognise that these things aren't going away. We're seeing more and more of them each year, and some of them have raised billions of dollars. So this is happening whether we like it or not, and how we think of it fitting into our existing legal system. So I think it is something that we should look at law reform on. Thanks, Michael.
Many thanks, Jason. Yeah, some again food for thought there. I guess the DAO and the joint stock corporation, are they competitors? And I did read something the other day when someone put the argument that law was going to be displaced to some degree by code. So that could be a
code is law.
an interesting territorial dispute between the computer coders and the lawyers. That'll be interesting. So thank you. Now our next speaker is Lee Reiners. Lee is a policy director at the Duke Financial Economics Centre and a lecturing fellow in law at Duke University in New York in the United States. Lee teaches fintech law and policy, cryptocurrency law and policy, and seminars relating to financial policy and regulatory practice. His broad research agenda focuses on how new financial technologies fit within existing regulatory frameworks. And his works also examine the risks associated with cryptocurrency derivatives, and the rise of digital investment advice, and corporate governance failures within the financial industry. So welcome again, Lee, and I know it's late over there, and I thank you again for being here.
Well, thank you for having me, Michael. Can you see my screen here?
Yeah.
Good, perfect. Yeah. So just a point of clarification, Duke University is in North Carolina, not New York. So I have to stand up for Duke. But I did live in New York prior to coming to Duke, and so I have affinity for both places. But I can tell you that the weather is much better in North Carolina than it is in New York. So But like I said, I love both places. So it's great to be with you. I'm going to provide a little bit of the US perspective, at least as much as I can, in a very short period of time. And I've enjoyed hearing from your colleagues there in Australia. So to start, I think Julie characterized the Australia regulation of crypto assets as schizophrenic. So I don't know, what that means for the U.S. Like maybe it's schizophrenic on cocaine or something of that nature, because the reality is that we have a very complex and fragmented financial regulatory system in the U.S., as you can see by this chart. And if this chart looks confusing to you, that is exactly the point. It is designed to be confusing and not understandable. In fact, this was taken from a JP Morgan presentation a few years ago, and they were trying to, I guess, generate sympathy for how heavily regulated they are. Woe is them, I guess. So this is the framework by which we have to figure out how does cryptocurrency and the offspring of cryptocurrency, be it stable coins, DAOs, CBDC, you name it, fit. And so just to kind of explain what you're looking at here, this was at the up top, you have the yellow boxes represent old regulatory agencies, and then the green boxes represent either new regulatory agencies or new powers given to old agencies per the Dodd-Frank Act that was passed in the wake of the 2008 financial crisis, and it fundamentally reformed the regulation of the US financial system. And at the bottom in the blue boxes, you have the specific financial services activity that's being regulated, and then the lines connect the regulator to the specific activity. As you can see, there's a lot of overlapping lines. So we have to figure out where does crypto fit? How does it fit? And the reality and the answer is that it doesn't. And in fact, cryptocurrency stands astride this framework. It doesn't fit neatly within it. And no one would design this framework from scratch. I'm envious of y'all in Australia who have the simple Twin Peaks model, right? There's a lot to be desired in that type of framework. But this system we have in the US is a byproduct of historical accident and political accident. And a classic example is the fact that the US is one of the few countries in the world that has a separate derivatives regulator from a securities regulator. In most other jurisdictions, those two functions are combined. But here in the US, we have the Commodity Futures Trading Commission that oversees commodity derivatives, which are most derivatives. And then we have, of course, the Securities and Exchange Commission overseeing the SEC. And right now, they're engaged in a bit of a turf battle when it comes to overseeing cryptocurrency. And these type of regulatory turf wars never end well. So with that, here's a little pop quiz for folks who want to play along at home. In the US, how do you think cryptocurrency is regulated? You think it's regulated as money, as a commodity, as security, as property, none of the above, or all of the above? I'll give you a brief second to think about it. And if you answered all of the above, you would be correct. So this is my semester in a slide here. I teach a full semester course on these issues. So I will kind of give you the 10,000 foot view. First, starting off, cryptocurrency is regulated as money at the federal level by the Treasury Department for purposes of enforcing laws around money laundering and terrorist financing, principally the Bank Secrecy Act. So what that means is that cryptocurrency firms have to register with the Treasury Department. They have to have an anti-money laundering program, and they have to file suspicious activity reports under certain conditions. We also have, federalist systems, so power is shared with the states in the U.S. And so states oversee money transmission, and so money transmission is licensed at the state level. So in practice, that means that a company like Western Union, for instance, is going to have a license in all 50 states. And so most states at this point have said that cryptocurrency does count as money for purposes of their state money transmission regime. So that's at a high level. And I should also note too that one state in particular has sort of gone above and beyond, and that's New York. And so New York has was the first state to develop a unique licensing regime specifically for cryptocurrency firms. They call it virtual currency firms. And that's referred to as the BIT license. And I'll note that the BIT license is much reviled within the cryptocurrency industry. Even though it's at this point 7 years old, and it's still a point of contention. And the new mayor of New York City, relatively new, Eric Adams, actually campaigned on trying to repeal the BIT license, because he wants New York City to be the home for crypto. So. But nonetheless, it remains in place, and it's, I would kind of characterize it as a traditional state money licensing regime, but souped up with a lot more requirements around cybersecurity and things of that nature. So then we have cryptocurrency that's regulated as a commodity by the Commodity Futures Trading Commission. And so in 2015, the CFTC said that Bitcoin is a commodity, and therefore, by extension, other cryptocurrencies that resemble Bitcoin are also commodities. And they have had a court, multiple courts at this point, back them up on Bitcoin being a commodity. Now, it's important to note that commodity spot markets or cash markets, where commodities are bought and sold, are not regulated at the federal level in the US. And that makes sense when you think about it, right? I mean, a jewelry store, for instance, is technically a commodity spot market. Does it need to be regulated at the federal level? Do we need the CFTC to regulate live cattle auctions, right? So, again, bringing it to sort of the practical here, what this means is that when you look at the largest cryptocurrency exchanges operating in the US, like Coinbase, for instance, they are not regulated at the federal level, because technically all they're listing, or at least all they think they're listing, are commodities, okay? And they're not listing commodity derivatives, because if they were to list commodity derivatives, then they would have to register with the CFTC to comply with a pretty robust regulatory regime. And so we'll kind of talk in a few slides, that is sort of one issue that folks sort of across the ideological spectrum when it comes to crypto recognize needs to change, that we can't have these crypto exchanges be unregulated, right? No one thinks it's a good idea for the NASDAQ or the New York Stock Exchange to be unregulated, yet that's exactly the situation we have right now in the US with these large cryptocurrency exchanges. So then moving on, in some instances, cryptocurrency is regulated as a security, and our securities laws, enumerate a number of things that are securities, things that we generally think of like stocks, bonds. But then there's this something called an investment contract. And in 1946, the US Supreme Court came up with a 4-part test in order to identify whether or not an investment contract exists, and therefore a security is present. And that's known as the Howey test. And the Howey test is what is being applied to various cryptocurrencies and cryptocurrency projects to determine whether or not they are a security. That test is, again, 4 parts. All 4 have to be met in order for it to be considered an investment contract. So is it an investment of money in a common enterprise with an expectation of profit? And that profit is derived from the efforts of others. And it's really those last 2, is there an expectation of profit, and is that profit derived from the efforts of others, that come to play when you look at cryptocurrencies. So you can kind of get into these very detailed, arguments around how centralized or decentralized is a given token. Why are people buying this? Is there an implicit or explicit expectation of profit? So, so most initial coin offerings, and this has sort of died down a bit. They were a big thing in 2017 and in 2018, were securities. But again, there's differences of agreement in terms of some pretty high-profile cryptocurrencies in terms of whether or not they're security. And in fact, the current SEC chairman, Gary Gensler, has indicated that Ether, the second most popular cryptocurrency, may in fact be a security per the terms of the Howey test, especially in wake of the merge, where Ether went from proof of work to proof of stake, which is sort of consolidating power in the hands of those who own more Ether. So, and the CFTC has said that they think Ether is a commodity. And in fact, we do have crypto derivatives, including Ether derivatives. So that's a fundamental disagreement there. In addition, any type of ownership vehicle, investment vehicle that owns cryptocurrency and then offers ownership in that vehicle would be considered a security. So this means that a exchange traded fund that tracks cryptocurrency is overseen by the SEC, and thus far the SEC has refused to permit the listing of a cryptocurrency exchange traded fund, much to the chagrin of many crypto supporters who kind of view the ETF as like the ultimate sign of institutional adoption, and you know, all their problems will go away in their mind. So then moving on, you know, cryptocurrency is considered property by the IRS, the Internal Revenue Service here. So that means you have to pay capital gains taxes anytime you use cryptocurrency. So again, if you were to use Bitcoin to buy a cup of coffee, you have to pay capital gains taxes, assuming Bitcoin went up from the time you acquired it to the time you spent it on coffee. And that's obviously not helpful if you're trying to get crypto to be a medium of exchange. So again, it's obviously all high level. That's my semester in a slide for folks down under. As we've talked about, so this is a lot of confusion, a lot of fragmentation, a lot of uncertainty. And the industry repeatedly is calling for, regulatory clarity. Give us regulatory clarity. Now, I kind of interpret that as a euphemism for, hey, we want light touch regulation and like no taxation, right? But nonetheless, I think they do have a point, and even crypto skeptics would say, we probably need to clarify some things a bit. And so this is an issue that's just calling out for, leadership, right? We're muddling our way through here. And if you go back and you look at, for instance, the 2008 financial crisis and the Dodd-Frank legislation, the way that all played out is it started with a white paper from the Treasury Department, which is an executive agency. And that white paper laid out, this is how we want to regulate the financial system going forward. They handed it off to Congress. Congress said, thank you very much. We'll get to work now. And the Dodd-Frank legislation that resulted pretty much mirrored what the Treasury Department and the White House, wanted. That hasn't happened in the cryptocurrency context. No one really wants to own this. And there was some hope that things would change this past March when President Biden issued an executive order on digital assets. And it really called on every single agency of the federal government to look at cryptocurrency and digital assets from their statutory mandate and develop, a number of recommendations and a number of reports. And that executive order, laid out 6 primary policy objectives. I don't need to read them all. You can see them here. But this was really interpreted as kind of a win by many in the crypto sector, because sort of the speculation leading up to this was that the Biden administration was set to crack down on cryptocurrency. And the executive order was anything but a crackdown. It was a recognition that crypto is here to stay. It's not going away. Therefore, the U.S. should attempt to harness its benefits while controlling and mitigating the risk. And you'll see here the last 2, are really around, the last 3 actually are really around the benefits. So, maintaining the U.S.'s status as the financial capital of the world, promote financial inclusion, and then support responsible technological innovation. But again, this is obviously all very high level. And we started to see over the last couple of weeks, actually, a number of these reports come out from various agencies. And, the tone amongst the crypto crowd has really changed, because these reports are very negative on cryptocurrency, and in fact, call for ramped up enforcement, regulation, and include a number of legislative recommendations. So I want to turn to kind of where the main sort of changes might be coming, and these are going to have to come from Congress via legislation. One is the gap in spot market regulation, as I mentioned previously. There is really just essentially no consumer protection whatsoever in crypto markets in the U.S. So, again, when you're using an exchange like Coinbase, Gemini, there's no registration or disclosure requirements. There's no listing standards. There's no requirements to get BEX execution. There's no custody standards. And, you think about it, these crypto exchanges are fulfilling a number of functions that in traditional intermediaries are separated, right? So they're the broker. They're also the executing exchange, and they're the custodian too. When I buy crypto on Coinbase, most people leave it in a Coinbase wallet, right? On Coinbase. Well, guess what? If Coinbase were to, for whatever reason, get into difficulty and file for bankruptcy, you would become an unsecured creditor. in the Coinbase bankruptcy estate. Obviously very different than if Charles Schwab were to fail or E-Trade were to fail and I had my stock portfolio there. So just, again, it's really the Wild West. The debate then is, okay, which agency should be given responsibility for overseeing crypto spot markets, and what should the extent of that responsibility be? And there's a roiling debate here in the U.S. right now over this. The Commodity Futures Trading Commission is the preferred regulator for the crypto industry. There's a variety of reasons for that. One, they've had, in my opinion, a pretty favorable approach and attitude towards the crypto industry. I would point to the previous chairman of the CFTC, Chris Giancarlo, who earned the nickname Crypto Dad because of his light touch approach to crypto assets, and he refers to himself as Crypto Dad. So I think that tells you a lot. There are others like myself who think that the Securities and Exchange Commission should be given oversight over crypto spot markets. And for a variety of reasons. I mean, one is the SEC at its core is an investor protection agency. That is in their mandate, unlike the CFTC. Another reason too, though, is that, crypto markets are very different than other cash commodity markets and derivative markets, which are largely institutional players, large sophisticated players, right? Average Joes are not, buying oil, for instance, right? So there's heavy retail participation in crypto, and the CFTC just doesn't have expertise and background in retail consumer protection. But then there are others who have floated, let the industry police itself, via some type of self-regulatory organization. There is a precedent for that in the US. We have FINRA, which oversees broker dealers. Now, FINRA itself is overseen by the SEC, so there is a degree of accountability. But then there are others who have said, listen, crypto is fundamentally new. And these other agencies are not fit for task here. Let's create a new agency to oversee crypto assets. But right now there is some momentum in Congress behind a bill that would give this authority to the CFTC. Another big kind of policy debate we're having right now is how to address stable coins here in the U.S. And I think Ross and others have touched on stable coins. Again, and these are non-CBDC stable coins, right? So these are privately issued stable coins. These are cryptocurrencies that are designed to maintain a stable value. The largest stable coins are known as fiat backed, so they have a reserve of fiat assets, treasury securities, in some cases commercial paper, deposits held at a bank. And I should note that there's a big difference, as there tends to be with crypto, between kind of the where the supporters sort of view a technology heading and kind of how it's used now. So a lot of stablecoin supporters say that these are kind of like the future of payments, and that's where things are heading. The reality is very different. So most stablecoins are used to trade cryptocurrency and participate in decentralized finance protocols. For instance, some DAOs that Jason mentioned. A lot of them rely on stablecoins. And so, depending on how they're used and how you think is going to influence how you think they should be regulated. And they kind of look like a lot of instruments that we're accustomed to. First, starting with deposits, right? You put $1 in, you expect to get $1 out. That's generally how people view at least fiat-backed stablecoins. So in the US, only banks can issue deposits. So should we require stablecoin issuers to become banks? Stablecoins also resemble in a lot of ways money market mutual funds. Again, you put $1 in, you expect $1 out. The fund invest in fairly liquid instruments, treasuries, commercial paper. You generate a small yield. Most stablecoins don't have a promise of yield, but nonetheless, kind of structured like a money market mutual fund. And then there's the casino chip analogy, and this is something that Gary Gensler has said, sort of like the entry ticket. So, in essence, you need stable coins to trade on crypto exchanges or to participate in DeFi. So it's sort of the price of entry. If you want to gamble, you need to buy the casino chips and you need to buy stable coins. So where the White House is and most banking agencies are, really on requiring stablecoin issuers to be brought into the banking fold, to be, a stablecoin has to be issued by a Federal Deposit Insurance Corporation insured entity, and that stablecoin issuer should be subject to prudential supervision and regulation, including requirements on the composition of its reserves. And I'll end with kind of touching on something a little bit that Jason mentioned, which is where I think kind of the policy debate is heading next is DeFi, decentralized finance. Decentralized finance are for financial services like we're used to, be it lending, market making, insurance, payments, you name it, that are conducted in a decentralized manner via smart contracts, which are self-executing computer code on the blockchain. So DAOs, for instance, are an example of a DeFi application. And, we've seen over the past couple of months some pretty significant kind of policy actions around DeFi that have really galvanized the crypto community and led to some thorny issues. And the first is the US sanctioning the virtual currency mixer Tornado Cash in August. So virtual currency mixer is, again, a service, a software, decentralized software that you can send your cryptocurrency and it sort of obfuscates the origins and the flows of that. So it mixes it with other cryptocurrencies. Think of a money laundering operation, but all conducted automated via smart contracts. So this was the first time that OFAC, the Office of Foreign Assets Control, which sits within Treasury, enforces US sanctions, has actually sanctioned a smart contract, a specific set of addresses, right? Not a person, not a legal entity, but a smart contract. And this could have the potential to have a chilling effect on decentralized software development. What does this mean for programmers that are building these tools? Can you even enforce this? So Tornado Cash is still operational and people are still using it. And what it means to be sanctioned is that it's illegal to either send money to Tornado Cash or receive money from Tornado Cash. And so what you've seen is a lot of people who are upset about this action here are sending small amounts of Ethereum to Tornado Cash and then designating that to go to kind of a high profile celebrity. And the celebrity is not having anything to do with this at all, right? They're just getting it sent to their address. And technically they're violating the law by the letter of the law, and they call this dusting. So the CEO of Coinbase, for instance, and a few others, and so the Treasury has had to kind of come out and clarify and say, listen, we're not going to go after people that are, receiving, cryptocurrency via Tornado Cash, and we're not, active participants in this. But nonetheless, it's, it's really raised, like I said, some interesting issues. Then on the DAO front, just last month, you had the Commodity Futures Trading Commission found a DAO to be liable for violations of the Commodity Exchange Act. So in essence, so this was a case involving Uki DAO was the name. And what it was essentially a decentralized cryptocurrency derivatives platform. And so the CFTC said it was an unincorporated association. And what's even more interesting is that it held that the governance token holders of the DAO, specifically the governance token holders who exercise their right to vote and participate in this DAO, were jointly and severally liable for the actions of the DAO. So again, you can imagine the chilling effect that this could have on many DAOs. Now, the CFTC has a fair point, and they say, listen, you can't just call yourself decentralized and skirt commodities laws. And the SEC has said the same thing. You can't just call yourself decentralized and skirt securities laws. But nonetheless, that's fine to say, but then how do you actually enforce it in practice to the extent it's truly decentralized? So I expect we'll see more cases where governance token holders are subject to enforcement actions. And in this case, it's interesting, they actually served process. So they notified the token holders that they were being sued via an online chat function that apparently the token holders use. So like I said, I think DeFi is the next big policy debate, but we still got to clean up crypto exchanges and stable coins. I could talk about CBDC, but I think Ross covered that well. I think there's a more vigorous debate around its utility in the U.S. than I think Ross touched on. But a lot of people are skeptical and view it as a solution in search of a problem, and I happen to be one of those people. So I'll leave it there. And again, thanks for having me.
Thanks, Lee. That was great. There was so much in there. I'm still sort of trying to process it all. That was very good. That was a very comprehensive. We haven't got that much time left, and we haven't got that many questions anyway. But we've got a couple. I'll see how we go. One is from Robert. Does anyone wish to make a comment on the exchange platform of XRP, which I think is Ripple, and as to who owns data? I don't know if anyone's got any thoughts on that.
I don't know exactly what Robert is referring to around data. I mean, there's right now, Ripple is, subject to an ongoing litigation with the SEC, and this is a pretty pivotal case. And depending on how it's decided, I think it'll really kind of have a big influence on crypto regulation going forward. So Ripple is the issuer of XRP. The SEC has said that XRP is a security per the terms of the Howey test. Ripple is denying that. They're saying it's decentralized and used for payments and this and that. I think in this case, Ripple is probably using the data. I don't know whether they own the data, but I think there's very little evidence that XRP is actually being used for payments. But nonetheless, they have a pretty high-powered legal team here, so they've been fighting it hard.
And if I can just come in there, remember, nobody owns data, right? It's under our legal system, you only control data by privacy rights or confidentiality rights, but there's no property rights in data.
Okay. Yayan's asked about the financing of blockchain and I guess the issue of mining fees. I guess, does anyone generally have any comment about the whole question, I guess, of mining in relation to Bitcoin, and is that, I guess, something that's sustainable in the long term?
Well, yeah, I have a strong view on that. I think Bitcoin, when I teach this, I tell the students to tip their head on one side, knock everything they know about Bitcoin out of one ear and start again. Because most blockchains that financial services will run on are not going to look anything like a Bitcoin blockchain. And they won't have this, ridiculous consumption of electricity. They won't need, there's lots of ways you can reconcile transactions on a blockchain. You don't need mining. So the problem is the only blockchain most people understand is the Bitcoin one, and that is a very clever one, but it's rather unusual and quixotic. So I wouldn't worry about that.
Yeah, I mean, to Ross's point, it depends on how decentralized you want your blockchain to be. Mining is very inefficient. It's energy inefficient. It's inefficient and it doesn't scale. But those are all trade-offs and intentional trade-offs that are made to achieve what was Satoshi's original vision of a decentralized, currency. So if you don't really care all that much about, decentralization, then there are more efficient blockchains. But it's a big problem. And if you move away from decentralization, then you're going to, you look at Ethereum, they moved to proof of stake, but they still have very high gas fees that hold it back from being, effective for, much of anything. I think Jason mentioned the Constitution DAO. People that put in Ether to that Constitution DAO, it wasn't even worth trying to get it back because of the gas fees that they were going to have. So yeah, I think, in most cases, blockchain is an inferior technology, frankly.
Yeah. And to the extent blockchains will be used in financial services, they won't be public blockchains, they'll be private permissioned blockchains. And the security perimeter will be on who gets to play, so there won't, and the public will access the blockchain through somebody who acts like a sort of broker or a node, but the public won't be writing anything to the blockchain. So as I said, it's a difficult thing to talk about because none of these terms are settled yet.
Syed, I guess raises, this has already been, I guess, discussed to some degree, the classification of crypto, whether it should be classified according to certain specifications to regulate them in certain areas, or whether a one size one-size-fits-all rule is better or appropriate. And I think Lee certainly made the point that it's 5 different things, depending on what you're looking at. But I mean, is it possible to get a one-size-fits-all definition or approach to, I guess, cryptocurrency, for instance?
Can I add a comment there? If those in Australia, if you think about the experience that we've had since 2001 with Chapter 7 of the Corporations Act, and the idea of, well, let's just create something called a financial product and something called a financial service. And, then of course, we need exceptions for this and exceptions for that. Then we need exceptions to the exceptions and exceptions to the exceptions and exclusions to all of that. And next thing you know, we've got 2,000 pages of legislation and, 4,000 legislative instruments. So can we not have a one size fits all? Because this is too diverse and too complicated and it's not going to work.
That's interesting on the financial services, because I think the Treasury's put out something about regulating crypto and talking about secondary service providers in relation to crypto, and sort of seems to be suggesting bespoke regulation rather than pushing it in under the financial services regime. And then we've also had, which is another area I sort of deal with, litigation funding, and that doesn't want to be under the financial services regime because it's so complicated and long and so on. So yeah, it's a big.
To back up what Jason said, if you create bespoke regulation, which is what Andrew Bragg said it wants in Australia, you create regulatory arbitrage, because ultimately you'll be able to tokenize almost anything. So if you have a special regime for tokenized securities, you have a regular securities regime, whichever is more favourable, all the market activity will move towards. It's not hard to tokenize almost anything at the moment. So you've got to reverse the new developments into the old developments and treat them the same way, irrespective of the technology that's being used to deliver them. Otherwise, you've got regulatory arbitrage on a grand scale, I think.
I think that's all we've got in terms of questions, and I think we're about on time. If anyone wanted to say anything else before we wrap up? No? All right, look, I want to thank all our speakers and their assistants who've helped them with this. I want to thank Addy and the Monash events team, and also some of our academics at Monash who were involved, Meredith Edelman and Tone Lee. And I also want to thank our audience for attending, and thanks everyone. I think it's been very interesting, very enjoyable, and we'll see you again soon.
Bye-bye. Thanks a lot.